Trump pushes temporary 10% credit card interest rate cap, igniting political and financial firestorm. Introduction: a new front in the affordability debate. President Donald Trump announced Friday that he is calling for a sweeping but temporary federal cap on credit card interest rates, proposing a one-year limit of 10% as part of what he framed as an aggressive push to restore affordability for American households. The announcement immediately triggered sharp reactions across the political spectrum, reigniting a long-simmering debate over consumer debt, Wall Street profits, government intervention, and whether price controls on financial products help or hurt working-class Americans. Trump's proposal, unveiled through a post on his Truth Social platform, places credit card interest rates squarely at the center of the 2026 economic conversation, alongside inflation, housing costs, wages, and household debt that has climbed to record levels. While the idea of capping interest rates is not new, Trump's framing, blaming the Biden administration for allowing rates to spiral out of control, adds a distinctly partisan edge to a policy area that has at times drawn bipartisan interest. In his Truth Social post, Trump accused credit card companies of exploiting American consumers by charging what he described as outrageous interest rates that routinely climb above 20% and in some cases approach or exceed 30%. According to Trump, these rates were allowed to flourish under the Biden administration, which he blamed for failing to protect consumers while prioritizing regulatory policies he claims hurt working families. Trump stated that beginning January 20, 2026, he is calling for a one-year cap on credit card interest rates at 10%, emphasizing that the proposal is designed as an immediate affordability measure rather than a permanent restructuring of the credit market. He described the cap as a necessary intervention to prevent Americans from falling deeper into debt during a period of elevated prices and financial certainty. Trump also highlighted the symbolism of the timing, noting that January 20, 2026 would mark the one-year anniversary of his return to the White House, framing the proposal as evidence of rapid action during his second term. Credit card debt in the United States has reached historic highs, driven by a combination of inflation, stagnant wage growth, rising interest rates, and increased reliance on revolving credit to cover everyday expenses. For millions of households, credit cards are no longer used solely for discretionary spending or emergencies. Instead, they have become a tool for paying rent, groceries, medical bills, and utilities, often at interest rates that compound rapidly. Average credit card APRs have climbed steadily over the past several years, fueled in part by Federal Reserve interest rate hikes aimed at curbing inflation. As benchmark rates rose, lenders passed those costs on to consumers, pushing APRs well above 20% for many borrowers. Critics of the current system argue that credit card interest rates are disconnected from actual risk, and that lenders are using market dominance and consumer dependency to extract excessive profits. Supporters of the existing structure counter that high rates reflect default risk, fraud losses, and the unsecured nature of credit card lending, especially for borrowers with lower credit scores. Trump's proposal drops directly into the middle of this debate, offering a blunt solution to a complex financial system. Trump's announcement fits squarely within his broader economic messaging, which consistently frames the Biden administration as responsible for rising costs, shrinking purchasing power, and financial stress on households. In his statement, Trump accused Biden-era policymakers of allowing credit card companies to operate with little restraint, arguing that regulatory priorities were misaligned and failed to address consumer pain. By tying high interest rates to Biden's leadership, Trump is attempting to position himself as the champion of affordability, an issue that polling consistently shows resonates strongly with voters across party lines. The strategy also allows Trump to connect credit card rates to other economic grievances, including housing costs, inflation, and wage stagnation, reinforcing a narrative that the previous administration mismanaged the economy at the expense of everyday Americans. Trump's plan bears striking similarities to legislation introduced by Senator Bernie Sanders in early 2025, which also sought to cap credit card interest rates at 10%. Sanders' proposal, however, differed significantly in scope and duration. Rather than a one-year limit, Sanders' bill would have imposed the cap through January 1, 2031, making it a multi-year structural reform rather than a temporary measure. Sanders has long argued that credit card companies engage in what he describes as predatory lending practices, extracting massive profits while trapping consumers in cycles of debt. Despite the overlap in policy substance, Sanders has been sharply critical of Trump, accusing him of failing to follow through on previous promises to rein in Wall Street. Earlier on Friday, before Trump announced his new proposal, Sanders publicly criticized Trump for what he described as deregulation of major banks and financial institutions during his earlier presidency. In a social media post, Sanders argued that large financial institutions have continued to post record profits, while consumers struggle under mounting debt burdens. He pointed to executive compensation figures as evidence that the system remains tilted in favor of Wall Street, suggesting that meaningful reform has been absent regardless of political rhetoric. Sanders' critique underscores a key tension. While both Trump and Sanders have expressed support for interest rate caps, they differ sharply in how they characterize the problem, its causes, and the role of government in addressing it.
For Sanders, the issue is systemic inequality and corporate power. For Trump, it is framed as a failure of leadership under Biden and an opportunity to deliver immediate relief through decisive action. Democratic pushback. Senator Elizabeth Warren calls it a joke. Democrats were quick to challenge Trump's announcement, with Senator Elizabeth Warren emerging as one of the most vocal critics. Warren dismissed the proposal as performative, arguing that calling on credit card companies to limit rates without robust enforcement mechanisms or long-term reform would do little to change consumer outcomes. She accused Trump of undermining consumer protections, pointing to his administration's past efforts to weaken or restructure the Consumer Financial Protection Bureau, CFPB. According to Warren, genuine affordability requires strong oversight, binding regulations, and sustained enforcement, not temporary caps or public appeals. Her critique reflects broader Democratic skepticism about Trump's intentions, with many arguing that the proposal is designed more for political messaging than substantive reform. Criticism also came within the financial world. Billionaire hedge fund manager Bill Ackman publicly warned that imposing a strict interest rate ceiling could lead to unintended and potentially harmful outcomes. Ackman argued that credit card lending involves significant risk, particularly for borrowers with weaker credit profiles. Without the ability to price that risk through higher interest rates, lenders may simply withdraw credit from millions of consumers. He warned that reduced access to traditional credit could push vulnerable borrowers toward other lending sources, including payday lenders, illegal loan sharks, or other high-cost financing options with fewer protections.
Ackman's comments echo long-standing arguments made by the banking industry, which maintains that interest rate caps distort markets and reduce access to credit for those who need it most. Despite concerns from Wall Street, Trump's proposal quickly gained traction among some Republicans. Senator Josh Hawley of Missouri publicly expressed support, signaling his willingness to vote for legislation that would cap credit card interest rates. Hawley has positioned himself as a populist conservative, willing to challenge corporate power, particularly when it intersects with consumer harm. His endorsement suggests that Trump's proposal could find support within a growing faction of the Republican Party that favors economic intervention on behalf of working-class voters. One of the central questions raised by Trump's announcement is whether the president has the legal authority to impose a nationwide cap on credit card interest rates without congressional approval. Historically, interest rate regulation has largely been handled through legislation, banking regulations, and state-level usury laws, many of which have been preempted by federal banking statutes. Implementing a nationwide cap would likely require congressional action or rely on emergency powers that could face immediate legal challenges. Trump has not yet detailed the legal mechanism he would use to implement the cap, leaving open questions about enforcement ability, scope, and potential court challenges. Another key distinction between Trump's proposal and previous efforts is its temporary nature. By limiting the cap to 1 year, Trump positions the policy as a short-term relief measure rather than a permanent restructuring of the credit market. Supporters argue that this approach allows for immediate relief while giving policymakers time to evaluate long-term solutions. Critics counter that a 1-year cap could create market instability, with lenders adjusting terms, fees, or credit availability in anticipation of the cap's expiration. If implemented, a 10% interest rate cap would dramatically reduce borrowing costs for consumers carrying high-interest credit card balances. Households with existing debt could see substantial savings, particularly those currently paying APRs above 20%. However, lenders may respond by tightening credit standards, reducing limits, increasing fees, or discontinuing certain card products altogether. The net impact on consumers would likely vary widely depending on credit profile, income, and reliance on revolving credit. Interest rate caps are not unprecedented in American history. Many states historically enforced usury laws limiting how much interest lenders could charge. Over time, federal banking laws and court decisions allowed national banks to export interest rates from states with looser regulations, effectively weakening state-level caps. Trump's proposal would represent one of the most aggressive federal interventions into consumer credit pricing in decades. Politically, Trump's announcement reinforces his populist messaging, positioning himself as an opponent of powerful financial institutions and an advocate for everyday Americans. The proposal also placed Democrats in a difficult position, forcing them to balance skepticism of Trump with their own history of supporting consumer protections. As the 2026 policy agenda takes shape, credit card interest rates may become a rare area where traditional party lines blur. As of Friday, no formal legislation had been introduced to implement Trump's proposal, and key details remain unclear. The White House has not released guidance on enforcement mechanisms, exemptions, or coordination with financial regulators. Without congressional action, the proposal may face significant legal and logistical hurdles. Trump's call for a 1-year 10% cap on credit card interest rates has injected new energy into the debate over consumer debt, affordability, and the role of government in financial markets. Whether the proposal becomes law or remains a political statement, it underscores the growing frustration Americans feel about debt and the cost of borrowing in today's economy.